Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to find the juicy details, maybe even a little bit of drama in the numbers too. Today we are diving deep into Plains GP Holdings, LPS latest annual report, the Big 10K, to see what their year really looked like and what is brewing for the future. So it looks like Plains GP Holdings LP, which we'll just call PAGP for short, had a pretty eventful year. They operate through Plains All-American Pipeline LP, or PAIA for even more brevity, which is a massive player in moving oil and gas. Think of them as the highways and byways for the energy that powers our lives, but with way more infrastructure involved. Let's jump right into the money. For the year ending the 31st of December 2025, their total revenues were around $44.2 billion. Now that sounds like a lot, and it is, but it is actually down from $48.8 billion in 2024. That is a drop of about 10%. The main reason for this dip is lower commodity prices, which means they're selling less in terms of dollar value. But here is where it gets interesting. Their services revenue, which is more about the fees they charge for things like pipelines and storage, went up by 4%. That is a good sign because it shows that even if the price of oil is down, people are still relying on their infrastructure to move it around. They're making money on the transport, not just fluctuating commodity prices. Now, when we look at their cost field, operating costs, the money they spend to keep their operations running, actually went down by 22% compared to the previous year. That is a significant reduction. It seems they became more efficient in running their day-to-day business. This efficiency combined with other factors led to a big jump in their net income, specifically for PAGDP itself, up 152% to $260 million. That is a huge leap and shows that despite lower overall revenues, they managed to become much more profitable on the whole. So what is the strategy behind all this? Papa, the operational arm, wants to be the top crude oil midstream provider in North America. This means focusing on running things safely and efficiently, providing market access for their customers and making smart investments. They're also in the process of selling off their Canadian NGL or natural gas liquids business by early 2026. This move is designed to help them focus solely on their more profitable crude oil operations and reduce their exposure to fluctuating prices and seasonal ups and downs. It sounds like a smart move to simplify and strengthen their core business. But it is not all smooth sailing. Every company has risks and PAGDP is no exception. They're exposed to a lot of things they can't control, like the price of crude oil and natural gas. Competition is also a big deal. Other companies are building more pipelines and storage, which can drive down prices and make it harder to secure business. Operational hiccups like accidents or natural disasters are always a concern, and cyber attacks are becoming a major worry for all companies, especially those in critical infrastructure. They also mentioned that the shift towards alternative energy could impact demand for their services long term. Now, for what investors likely care about distributions or dividends, PAG aims to distribute all of its available cash to its class of shareholders within 55 days after each quarter ends. For 2025, they paid out roughly $1.52 per S-share. That is up quite a bit from $1.27 in 2024. This increase in distributions is a really positive signal, suggesting the company is confident in its financial health and its ability to generate strong cash flow, which is great news for shareholders. Looking at cash flow from operations, continuing operations for 2025, they generated about $2.4 billion. That is a solid increase from $2.2 billion in 2024, showing healthy cash generation from their core business. On the investing side, they were quite active. In 2025, they spent around $3.4 billion on capital expenditures, including roughly $2.8 billion on acquisitions. This is a massive jump from just $737 million in 2024. The biggest chunk of that was for the Epic acquisition, which they say is highly synergistic and strategic. They're clearly making big bets to expand their footprint and capabilities in the crude oil midstream space. Now, about that debt, at the end of 2025, their total debt was about $11.2 billion. That is a big number, but it is up from $7.6 billion in 2024, which is largely due to those significant acquisitions and the new senior notes they issued. While they have strong liquidity and access to credit facilities, this level of debt is something to keep an eye on, especially if market conditions become less favorable. The company's management and their independent auditors have stated that their internal controls over financial reporting were effective as of the 31st of December 2025. This is a standard but important confirmation, meaning they believe their systems are in place to ensure accurate financial reporting. The auditors did highlight one critical audit matter about the valuation of pipelines and equipment acquired in the Epic acquisition. This is common with big acquisitions because valuing complex assets like pipelines involves significant judgment and specialized skills. It means the auditors paid extra attention to that part of the accounting process to ensure it was done correctly. Let's talk customers. ExxonMobil and its subsidiaries were a huge part of their business accounting for about 31% of revenues in 2025. BP also made up about 10% in 2023. While having such large customers provides stability, it also means PAGP is exposed if one of them were to significantly reduce their business. Losing a big customer like that could really impact their bottom line. So what is my take? PAGI is making a bold strategic move by divesting its Canadian NGL business and doubling down on crude oil. This focus, coupled with increased distributions to shareholders, is a positive sign. They're clearly trying to streamline and improve profitability. The debt load is substantial after those recent acquisitions, but their ongoing operational efficiency and strong demand for their core services suggest they can likely manage it. The risks around commodity prices competition and regulatory changes remain, however, especially considering the global energy landscape is always shifting. Looking at the numbers, PAG seems to be navigating a complex market effectively by focusing on its strengths and shedding less profitable assets. The increase in shareholder distributions is a strong indicator of their financial health and commitment to returning value. While substantial debt and ongoing market risks are present, their strategic direction and operational improvements paint a picture of a company actively managing its path forward. Alright, that is our deep dive into Plains GP Holdings LPS financials. What do you think about their strategy and these numbers? Let us know in the comments below. If you found this breakdown helpful, smash that like button and subscribe for more corporate decoder content. And don't forget to join our Discord community linked in the description for even more discussions. Thanks for watching, and see you next time.